So where are we now? We've completed 4 of our steps in our Profit Mastery program, and now we're ready to look at long-term growth and the cost of long-term growth. So we've just finished a section on managing cash flow, and what we need to do now is take a look at managing growth. And the tool we're going to look at to do that, we're going to give it a name. We're going to call it financial gap. And we got to now give it a definition. We'll define financial gap as the difference between the money you got and what? The money you need. And who typically gets asked to fill the gap? The bank. So that's going to be our definition, and we'll be able to, rather than hoping it works out, we'll be able to predict how much money we're going to need. Our goals for this section are really pretty clear, and there's only a few of them. All right? And what we want to do is understand why growth costs money, forecast what we'll need for growth, identify how better management can free up capital for growth, and answer out how much we're going to need to borrow and when we'll be able to pay it back. That's our goal, all right? So, what we really want to do now is we really want to look at financial gap and figure out how it works. Here's what happens. Customer comes into the bank and says, I need some money. Typically, what's a banker going to say? How much? He or she says $50,000. Where did they get that number? That's what I think I'll need. We're going to use this financial gap tool to actually calculate how much someone's going to need based on the structure of their company. And what do we usually find out? Is it most common for people to overestimate or underestimate what they will need? Under. Well, if we underestimate, what happens? Halfway through the year, we'll be back. And sometimes they won't be ready for us. It's better to get it right what? The first time. How long do you need it for? That's the second question. About 90 days. Once again, is it most common for the business community to overestimate or underestimate? Under. So what we're going to find financial gap to be an incredibly powerful tool to do is to answer 2 questions. How much? How long? And if we can get those 2 right, we go a long way toward making our job easy by making our banker's job easy. It'll be a better way to communicate, all right? So that's what we're trying to accomplish. In order to do that, we have to go back to the very beginning of the course now, to that financial operating cycle. You remember that? The owners and the creditors put up the money to buy the assets, and we use assets, we own assets to do what? Create sales, and we create sales to make a profit. We pay some tax on it, and then what are the 3 things we're going to do to complete the cycle? We're going to reinvest it, we're going to repay debt, and we're going to take some home. Isn't that right? And that completes our cycle. My business is growing. That's what we hear. What do you believe most business owners are referring to when they say my business is growing? Sales. Would you agree? I think that's probably pretty clear and pretty reasonable. Sales are going up. So growth is reflected by sales and hopefully what? Profit. It would be nice if profit went up. And but is it possible that we could, if sales were going up, is it possible for profits not to be? Yeah. Mm-hmm. I have a feeling that people would still say my business is growing. But it would be nice to have profits too. Either way, we're going to measure both of those on which financial statement? Balance sheet or the income statement? Income statement, right? So if we record the growth on the income statement, where do we record the cost of growth? On the balance sheet. Or maybe a better way to say it is, if we record the growth on the income statement, where do we pay for it? And we're going to pay for it on the balance sheet if we can. That's sort of the model. Now, to get at that, what we really need to do is we really need to go back to that financial operating cycle and go the other way. And what I mean by the other way is really clear. There's our financial operating cycle, all right? And we said growth means sales are doing what? Going up. Now, sales going up, and our arrows go this way, don't they? Our arrows go counterclockwise, isn't that right? That's how we went through this in the whole first place. Now, let's go the other way. Sales growth causes a need for more what? Assets. Assets causes a need for what? Sources of money to buy the assets. Now, the interesting thing is, once again, we're reinforcing that linkage between the balance sheet and the income statement, aren't we? Now we're going to use it as an incredibly powerful tool because this relationship is very measurable. Sales cause a need for assets, which causes a need for sources of money to buy the assets that lives in the house that Jack built. Now, here's the going the other way. If you can't get the sources of money, then you can't buy the assets. And if you can't buy the assets, you can't make sales. So it works its way all the way back to sources of money to grow. And that's where we've got to start. I claim there are 4 sources of money to grow. And those are, number 1, give me those 4 sources of money to grow. Number 1, the bank. Number 2, net profits that are kept in the business in the form of, what's the RE? Retained earnings. So we didn't take them out. If we take them out, they're not there to fund growth. But if we leave them there, they are. What's another source of money to grow? Put some of your own money in the business. And what's the last one? I'll gladly pay you Tuesday for a hamburger today. Trade credit, or what we'll term free liabilities. Free in the sense that if we pay our creditors on time, what's our interest rate? 0. All right? 4 sources of money to grow. Let's just take a moment and take a look, explore them. New equity. Why don't you put some more of your own money in the business? What's the answer? I don't have any more. It's already all in there. Or as I was told once by an older gentleman who had clearly been doing this a while, you got this backwards, boy. The goal is not to put more in. What is the goal? To take more out. Something wrong with you, son? I claim that's probably going to be 0, huh? Net profits, I believe, are usually little. Why? We hire an accountant to make them little. In the past, that's what the accountant's role has evolved to, like it or not. Trade credit has a limit, doesn't it? About 60 days. And then what 3 letters? The fish. COD. COD. They're cutting us off. So where does that leave us? Leaves us at the bank. But I can guarantee you that very few bankers have ever had their customer come in and say, I've used up all my other 3 sources of money to grow, and you're my last hope. First of all, that doesn't sound like a terribly good negotiating strategy, does it? But in fact, what do we know by virtue of you all showing up? You have indeed used up all the other 3 sources, because if the other 3 sources are adequate to fund your growth, where don't you go? The bank. So by showing up, we know you're out. It's really as simple as that. This financial gap concept will help us put this whole tool in perspective as to how to use it. All right? Now, what I want to do, I've got a little case study, and if you will turn to your page that's labeled Evergreen, I believe it's labeled Evergreen, I want to take a look at how it works. Now, very simple. The tool is going to be called financial gap, yes? The difference between the money you got and the money you need. The mathematical technique we're going to use in this section will be called percent of sales. Percent of sales. You with me here? Now, what you can see is I've labeled each of the, I've got a balance sheet here from our just completed year end for our Evergreen Distributing, who has sales this just completed year of how much? $600,000. And by the way, depending on the size of your business, if this isn't big enough for you, just keep adding zeros till it works, okay? You add 3, 4, 5 zeros, and we can cover most any business. It doesn't matter how many zeros, or even one less, two, it doesn't matter. The process works, all right? Now, very simple. First of all, let's take a look at the case study that we have. His total assets, Evergreen has just completed his year. You have an instant statement, and here it is. Total assets are what? 558. Liabilities and net worth? 558. Really good thing. The balance sheet balances. Great start. All right? Now, what I've done is I've calculated each of his asset categories as a what? Percent of? Sales. Percent of? Sales. Percent of? Sales. Okay, it's not a record that's stuck. It's important to remember that it's sales. It's so common for us to express it as a percent of total assets because that's what we've always done in the past. That's just a cataloging function. It's a percent of sales because it's the sales on the income statement that create the need for what? The assets in the first place. You with me here? We buy the assets to support the sales. Once again, we're coming back to that incredibly pervasive concept of the linkage between the balance sheet and the income statement. We can't forget that, and we will continue to see the value of it probably demonstrated the most right here in the financial gap section. And let's think of this, let's give it a name so we can really know what we're talking here. Think of this as a measure of what? Efficiency. Not efficiency of operation, that's over on the income statement, but efficiency of capital. How effectively are we using capital in this business, all right? And I've actually measured it. Cash of $24,000 is what percent of sales of 600? 4. Receivables of 108 is what percent of 600? 18. Inventory of 156 is what percent of sales of 600? 26. And equipment is 25. You with me? Where did I get this? I didn't make it up. I got it off my immediate statement, didn't I? I know what I just did in sales for this year, and I know what I have on the balance sheet, right? It's not 5 years ago, it's not 3 years ago, it's not out in a year, it's right now. This is where I am. This will be a measure, therefore, of my capital what? Efficiency. Do we know if those numbers represent good, fair, or terrible management? No, we don't. Could we? Yes, if we had what? Some benchmarks, some comparatives from somewhere. Well, one comparative is we could look at him, not this year, but what? Last year or the year before, huh? That's one way. We could get industry data. That'll work too. All right. Now, here's what I want to do. I want to break this down to $1, okay? What this says is, if cash is 4% of sales, if cash goes up $1, how much will I need in additional cash? If sales go up $1, what will I need in additional cash? 4 cents. If sales go up $1, what will I need in additional receivables? 18. Inventory?
26.
And equipment? 25. So when sales go up $1 in this company at this level of efficiency, my assets got to go up how much? 73 cents. Now, if my assets got to go up 73 cents, my liabilities and net worth probably ought to go up what? 73 cents, because we'd like to see a balance sheet do what? Balance. So the mathematical sign that's going to go in, equals. So here's what we're going to do. Just like we did in section 2, we're going to go down the left side of our balance sheet, buying the assets at some level of efficiency, right? We're going to go across by the equal sign, and we're going to come up the right-hand side. We're going to go down the left-hand side, buying the assets. We're going to go across, and we're going to go up the left-hand side, what? Thank you. Paying for them. Paying for them. Buy them, then we got to have sources of money, and we'll go up the other side paying for them. That roadmap right there, follow that path. And where do I end up? I end up at a box that I've labeled what? Financial gap. Who is that? That's the bank. Isn't that right? Again, they become the court of last resort. Just like we talked about, they become the court of last resort, all right? And the way we're going to buy them is going to be driven by what? Our level of efficiency. If this is my company, and you have and Randy has a company, same company, would his numbers necessarily be the same? Not unless he's operating at the exact same level of efficiency as me. He might be operating a lot better. Well, maybe there's some room here for what? We're going to first measure this based on how I am today, assuming I'm not going to change. And then if we don't like what we see, what will we talk about doing? Change. Managing this. Everybody puts on that income statement hat. Manage the income statement. What we'd really like you to do is put on a hat that says balance sheet manager. Because if you can manage the income statement, you can manage profits. If you can manage the balance sheet, you can manage what? Coming back to that same consistent theme. Profits on the income statement, cash on the balance sheet. That's where we're going to go. Now, going up the other side, let's just take a quick look at this, and then we'll move on and grow this business, because that's where he wants to go. He wants to grow it. Liabilities and net worth is 558, right? What's his net worth today? 286, right? Now, if we know the liabilities and net worth is 558 and the net worth part is 286, how would we get the total liabilities part? If you know the total in one, how do you get the other one? Subtract. 272 of total debt. The long-term part is 140. What's the short-term part? 272 minus 140. 132 for current liabilities. 7%, 7 times 6% of sales. Thank you, percent of sales. Always think percent of sales. 7% of 600 is 42. 15% is 90. 132 is made up of 42 and 90. And our plug today that's going to fill the gap is how much?
0.
0. Today, we don't need any money from the bank. Next year, he wants to go to what? 900,000 in sales. Is he going to, and what did he tell me he thought he needed? What did Tim tell me he thought he needed? 50,000. Well, let's project it out and see how he did. So I'd like you to set your 900,000 case worksheet right next to the 600,000. Have the 600,000 on the left. You're going to need it because that's where you're starting. Have the 600,000 on the left, the 900,000 on the right. And when we get back together, we'll take a trip through this 900,000 and we'll see how Tim did.